This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Eric, it's great to have Michael back on the show. Now let's get to that chart deck. Listeners, you're going to find the download link for the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, that means you have not yet registered at macrovoices.com. Just go to our homepage, macrovoices.com, and click on the red button over Michael's picture saying, looking for the downloads.
Well, Patrick, it's starting to look like the S&P chart could finally be topping, maybe after hitting my target of 6,500, but we're already bouncing off that 34-day moving average. What are the charts telling you, Patrick? Is there more downside still to come?
Eric, what a great question. The short answer is yes, but it's about how and what form it's going to occur. What we witnessed here in the last week was a clear sector rotation. What we saw was the selling was predominantly focused in the technology space and the AI space, which was down over 3% over the past week. At the same time, that money was redistributed and started to rotate. We saw not only international strength in things like money flowing into the Nikkei or the Euro stock, but also in the defensive sectors. We saw a very strong push higher in the healthcare space, in consumer defensive names, and even in the energy space. And so there was money that was being essentially redistributed. Now imagine these big money managers that are now massively overweight these tech names just simply because they were where the rally was occurring in their portfolios. And in a very typical rebalancing and reweighting, they would sell down some of these positions and reallocate that to where there is more asymmetry in opportunities and definitely less volatility. And so we are definitely seeing that rotation. Now, NVIDIA's earnings is going to play a very pivotal role in this next week, because if NVIDIA in any way disappoints to trigger some distribution to continue, then we will see under the surface this rotation continue. Now, these Mag 7s and other big stocks are so huge to the S&P 500, even though this rotation will be getting underway, it would be generally a drag on the S&P 500. And it certainly would imply that we are likely continuing to see a bigger topping formation where we're going to see substantial overhead resistance and far more of a sideways consolidation. The best example was from November of last year through February of this year. There was about a 4-month period where the S&P 500 more or less remained within a several hundred S&P point range, trading more sideways. I think that is, at least for the next few weeks, likely. As we get into September and we get into the September jobs numbers and the first Fed rate cut, there's all sorts of room for volatility that may ensue going into the fourth quarter of the year. But right now, in the short term, while we may see the S&P weaken a little bit further, let's say down to 6,300 where its 50-day moving averages, I think the bigger theme is how this sector rotation is going to be occurring under the hood. All right, Eric, let's move on to that US dollar index. What are you thinking here?
Well, Patrick, my read of the chart is that we're settling into a horizontal consolidation that's centered around 98, even on the Dixie, plus or minus 2 big handles. So in other words, 96 to 100 is the trade range on the Dixie that I think we're settling into, most of that happening between 97 and 99. We'll need to see a sustained move above 100 or below 96 to say that that consolidation has ended, and obviously that's a fairly wide range. My fundamental bias is still strongly dollar bearish relative to both other currencies and hard assets.
Yeah, well, Eric, in my view, the US dollar has clearly found a fair value zone, and we certainly have started to see divergent action in a number of the different cross currencies. When the US dollar really starts trending in a meaningful way, we tend to see almost all of the cross currencies correlate and move together in either direction against that US dollar. Here we have a very mixed bag. While the euro and the pound sterling stayed clearly in trend, we see the CAD and the Japanese yen very much diverging and therefore making a big muddle, and overall no real conviction on it. It's very likely that some of these catalysts, such as the Jackson Hole and or potentially the first Fed rate cut in September, could wake up the currency markets. But at least at this juncture, the activity in the currency markets is very narrow, tight, trade range bound, pivoting right on its 50-day moving average, and no conviction of a move yet. At this stage, I think expecting the next few weeks to have more of this types of sideways price action and inactivity to continue in the dollar is certainly, in my opinion, the highest probability. There will be a bigger move, but very likely it's going to be pushed out into the fourth quarter of this year. Now, Eric, on page 4, I have that chart of the crude oil. What are your thoughts here?
Well, Patrick, so far the market seems to want to hold support on that 100-day moving average, which is 62.59 on the October WTI chart. So Wednesday gave us the closing print that technically suggests maybe the bottom's in now, but will it hold? Let's see what the market brings. If we can stay above 62.59, that 100-day moving average, then this recovery's got some legs to it. Maybe the bottom is in.
Well, Eric, I'm not overly bearish crude oil here, but it is in a primary downtrend and it's still being distributed. The vulnerabilities of it potentially having a trip to retest the April and May lows, something that cannot be ruled out. At some stage, I do believe that crude oil will bang out a bottom here, but it could probably be a story that takes the remainder of August and early into September in order for us to really establish that. At this stage, I remain neutral crude, but I actually do believe that there's going to be a compelling buying opportunity to come in the weeks and months to come, just looking for where a meaningful entry point will make sense. All right, Eric, let's move on to gold. What are your thoughts?
Well, Patrick, the correction we've just had made perfect sense. The market mood was peace for Ukraine, was at least coming into view on the horizon, if not almost at hand. So geopolitical hedges started to unwind. The slow stochastics and the RSI finally bottomed on Tuesday into Wednesday, and I think we may be on the cusp of a surge higher to new all-time highs in gold. I think we may have just seen that swing low that leads us into the next surge higher that hopefully breaks us above the previous 3,500 or just above 3,500 all-time high. Now, of course, anything's possible, but we've gone from extreme overbought on the slow stochastics to extreme oversold. And the setup for a breakout to new all-time highs is much better now than it was the last time the market tried but failed to break to new all-time highs. Better yet, we got from extreme overbought to extreme oversold on the slow stochastics without putting in a lower low on the price chart. So we shook off all of that overbought, got back to extreme oversold, and we're still showing a bullish setup in terms of the pattern of higher highs and higher lows, even after shaking off the overbought condition now into extreme oversold. So that leaves us with bottoming stochastic oscillators coincident with a nice solid recent pattern of higher highs and lows. I like that. I added to my gold longs on Wednesday accordingly. I'll cross my fingers and see what happens here.
Well, what is clear, Eric, is that gold has been in a sideways range-bound wedge for many months and has not yet shown the conviction of breaking to those 52-week new highs to drive that next bull impulse. At the same time, silver has stalled out. We've seen platinum and palladium also deepen consolidation. The only interesting observation to make here is that gold miners continue to take flows and they continue to show relative strength and continue to actually remain in trend. It'll be very interesting to see whether gold miners can bullishly continue to diverge from the trade range bound markets of the rest of the precious metals and continue to drive further new highs. Overall, at some stage, the bigger bull phase of another leg higher in gold will inevitably come, but at least at this moment, there isn't to me any of the technical signs that this is imminent. All right, Eric, let's talk about uranium and this current correction that we're seeing. What's your thoughts?
Well, all sorts of pundits are taking all sorts of different guesses, and I assure you they are all guesses, as to what's the proximal catalyst for the very sharp sell-off in uranium miners on Monday continuing into Tuesday. Well, the reason for the pullback is, drum roll please, because the market was overextended to the upside and needed a pullback, which experienced bulls will welcome as an opportunity to buy the dip. To my thinking, the most likely proximal catalyst to explain why it suddenly broke on Monday is peace expectations around Ukraine, spooking hot money that never bothered to learn uranium fundamentals in the first place to come to the wrong conclusion. What's going on is peace with Russia is actually bullish uranium, not bearish. We've explained why in past episodes. But the tourists don't know that. They hear that sanctions could be lifted, and they're just imagining those stinking Russians flooding the market with all their cheap uranium, those pinko commie bastards. Well, little reality check, folks. They don't have any significant uranium inventory to flood the market with. The market doesn't work that way. It's much more about conversion and enrichment capacity, and there's really no reason to think that the peace deal that's on the table would even result in ending the bipartisan Russian uranium import ban in the first place. So the whole logic doesn't make any sense, but the point is, there's more of them than there are of us. There's a lot more hot money idiots that are selling hard right now because they don't understand the fundamentals. They're going to beat the price down. I hope we can get down to, let's say, below 34 on URA. I think that's probably coming, and I think it's a great buy range between 32 and 34 or so on the URA ETF. But the longer-term bullish story couldn't possibly be stronger. This is the beginning of the long-awaited buyable dip. We need some kind of catalyst to bring it on. I'm guessing that catalyst is what I just explained about Ukraine war risk coming out of the system. Maybe that has nothing to do with it and it's something else. I don't know. There's a bunch of theories about it. One way or another, we're getting the long overdue correction. I still expect in late Q3 and Q4 that this market really takes off to the upside. So the question is, if you're really good at buying dips, find the bottom. I'll definitely start buying URA at 34 and keep scaling in if it comes down from there.
Well, Eric, in my framework, every rally needs to be checked. And after such an epic bull run where we saw a doubling of uranium stocks between April to end of July, eventually was going to have some sort of a pause and reversion. Now, typically, when you have a very strong bull market and this type of a pullback, you always want to make the assumption that pullbacks are buys on dips. The bigger question is, will this be a full 50% retracement where something like the URA drops all the way down to the low 30s, or will this just be one of these quick corrections where we temporarily break below the 50-day like we currently are and almost immediately gets bought on dip? One way or another, we're in the midst of a correction that should offer the first compelling buy on dip opportunity that we've seen since the rally started back in April. So we'll see where it settles in. I would suspect and ideally want to see, let's say, the URA trading down to the $34, $35 level. And at least there you have some asymmetry, even if there is a few dollars of volatility around it, where we could be looking for the short-term buy on dip traders that can take this right back into the 40s on a potential advance. Now, Eric, copper has been relatively quiet here, just consolidating after that big tariff pop and drop. How do you continue to size this up?
Well, the lack of even a full-fledged dead cat bounce is frankly starting to concern me on this chart. The logical mean reversion retrace level on the HG chart was around $5. We're barely holding $4.50. I can't explain that. I don't see any other recession risk indicators that are telling me that there's an oncoming recession, and we absolutely positively do need lots and lots of copper to keep growing the global economy. So if the copper market is stagnating, that probably means somebody thinks the global economy is about to start stagnating, or this copper market needs to recover. Again, I think this did happen because of tariffs, but we ought to be seeing some recovery here, and I don't understand why we're not getting it. Finally, Patrick, before we wrap up this week's show, let's hit that 10-year Treasury note chart.
Well, Eric, I just wanted to wrap by just touching on that 10-year Treasury yield, which we continued to see lower highs, lower lows. Now we see a rejection at a basic moving average fib zone. And so we clearly have a yield that is weakening and a potential bond market that may run. Now, I'm not super bullish bonds, but I also think that if they weren't going to break down and yields blast off north of 5%, that we were inevitably work to the bottom end of the yield range, which is down near 3.5%. So are we about to see a trip down under 4% on the 10-year Treasury yield? It's entirely on the table, and certainly of some short-term safe haven in some bond holdings may be in store. What I particularly like about this, Eric, is that it's definitely a contrarian play. It's certainly out of consensus, and there's a lot of people that at this stage continue to not like bonds. And so typically some of the best moves happen when everyone is offside on these trades. And I don't think right now there's a lot of people looking at these bonds as an opportunity.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.